Hello everyone, thanks for checking out my video. The S&P 500 fell last Friday as it posted back-to-back losing weeks for the first time in nearly 5 months. The stock market was under pressure because two sets of inflation data came in hotter than expected. The reports basically suggested that inflation remained stubborn. As a result, investors continued to dial back their expectations for rate cuts in 2024 and adopted a cautious approach ahead of the Federal Reserve meeting this week. So, as inflation remains sticky, should we be worried? And what should investors look out for in the upcoming FOMC meeting? Let's cover them all in this video. Stay tuned throughout to find out more, right? The US stock market slipped last week as hotter than expected inflation reports spooked investors as they weighed the impact of this hot inflation data on the Federal Reserve's policy decision this week. So what happened was that on Tuesday, both headline and core CPI came in higher than estimates. Basically, February's headline CPI rose to 3.2%, which is above the expectation of 3.1%. While core CPI inflation was at 3.8%, also higher than the estimate of 3.7%. Initially, the market seemed unfazed by these slightly hotter CPI numbers, but then on Thursday, headline PPI showed an increase of 1.6%, which is much higher than the estimate of 1.1%, and this is actually the biggest move since September 2023. Well, with both consumer and producer prices rose more than expected, it appears that the inflation could be stickier and more difficult to tame than what the Federal Reserve had expected. This new set of data could potentially have some impact on the Fed's policy decision this coming week. This then brings me to the next point, the FOMC meeting, which is going to take place on 19th and 20th March. Investors will be looking for more clarity on the rate cut trajectory for this year. As of the time of recording, according to the CME Fed Watch tool, the market is predicting a 98% probability of the central bank keeping interest rates unchanged this month. In case you're not aware, the Fed will conclude their policy meeting and review their policy decision on Wednesday. The Fed will also be releasing their dot plot of interest rate forecasts. Just to add on, back in late 2023, the Fed had forecasted 3 rate cuts in 2024, but with the inflation coming in hot recently, they could revise their forecast to just 2 rate cuts. Other than the dot plot, investors will also be interested in Jerome Powell's post-meeting press conference as he is going to verbalize the Fed's views on inflation and of course the potential rate cuts for the year. Most investors believe interest rate cuts will arrive this year, it's just a matter of when or which month. In my view, the latest inflation data has kind of complicated the timeline, causing more speculations on when will the first rate cut take place. Okay, other than the FOMC meeting, we have 2 other key events taking place this week. The first one is this 4-day GTC conference that will be held by NVIDIA starting on Monday. There will be a 2-hour keynote by the CEO Jensen Huang outlining what's ahead for NVIDIA in the year ahead. Just to share, in previous years, NVIDIA has used this conference to debut some of its biggest products. So, I think we can probably expect a new AI chip, updates on their data center, hardware, software, basically a series of AI-related announcements. Next up, we have Microsoft holding its new Era of Work event on 21st March, where the company is expected to unveil new Surface hardware, Windows 11 features, and the latest development and progress of its Copilot AI. Other than NVIDIA, Microsoft is also a key player in the AI boom, as it is at the forefront of monetizing AI tools for end users. Its latest AI development could be crucial for the entire AI ecosystem, as it pushes many other tech companies to innovate and think of ways to monetize their very own AI tools. It's actually quite evident, as we probably haven't seen Google felt so threatened in so many years, to a point where they were forced to innovate and quickly come up with products to rival Microsoft's AI tools. And then we have Apple trying also very hard to catch up with the AI wave. Even Meta, who once pivoted and talked so big about Metaverse and their silly reality lab, has shifted their focus to their AI products. Okay, in summary, this throw of big events will quite likely shake things up for the overall stock market, especially the tech and AI industries. I would expect some huge swings and movements throughout the entire week. So now let's cover the technical segment to prepare yourself for some potential wild movements this week. In terms of the broader market, specifically on SPY, if the pullback continues this week, I would actually expect SPY to break below 504 and test the gap area. The range of the gap is 495 to 501. Support level to watch would be the bottom of the gap, as that is where the 38.2 Fibonacci retracement level sits as well. Further bearish momentum could bring SPY further down to around 490 to 493 range. This range is very important. I repeat, if the pullback continues this week, watch this area carefully. The reason is because this is where the green uptrend channel line is, as well as where the 50 moving average sits. I have shared many times that a retrace and rebound is very healthy and bullish. So if we can get it this or next week, then a new all-time high could be in the picture. However, if SPY somehow falls back into the green uptrend channel, I would say the trend is changing. The last line of defense lies at a critical 61.8 Fibonacci level, which is around 484. But at this moment, I don't see major negative news that could bring SPY below this level. Therefore, if anything, I think it would be a healthy pullback and bounce off some of the key levels that I have highlighted earlier. Oh, just to add on, if somehow Nvidia, Microsoft or even Jerome Powell's speech are positive, SPY may not even retrace that dip. It could just bounce off the first Fibonacci level at 504 before pushing towards all-time high at 521, where the next resistance level is. Let's now jump over to Apple's chart. Apple's chart is looking interesting because we have a bit of conflicting signals, so pay attention to what I am gonna share next. So last week, Apple was moving sideways for the entire week. This means Apple still couldn't gather enough buyers to push the stock further up. So does it mean Apple is gonna fall further? Is this bearish? Well, not really. Because Apple could be bottoming out. In layman terms, it's consolidating and forming a base. That may not be bad news for the bulls because it seems like sellers have dried up a little bit and we are waiting for buyers to step in. Okay, so what should we look out for to identify Apple's next trend? First of all, for Apple to regain its bullish momentum, just like what I have shared in my last video, we need to see Apple going above 175. I mean, as you can see from the chart, Apple went near that level last week on a few occasions, but just couldn't push above it. Come this or next week, if Apple goes above 175, it will also mean that the stock is breaking above this purple downtrend line. Then, that's a small signal of reversal in trend. And it could be a trading or quick scalping opportunity to ride the upside towards the gap at 177 or even the next Fibonacci level at 179 before resistance comes in. The stop loss would be the purple downtrend line. In other words, if Apple climbs above 175, retraces, and then fall back below the purple downtrend line, that is called a fake breakout. And from there, Apple's bearish momentum could continue. Just to add on, Apple had a death cross on the chart last week, with the 50 moving average crossing below the 200 moving average. Some may argue that these moving averages are lagging indicators. Well, I do agree on that, but on many occasions, it has proven to be a continuation of a bearish trend. To highlight, the last time we saw this on Apple's chart was back in 2022, and right after the death cross, Apple fell from 140's range to 120's range, dropping 10% in the process. And just recently, we saw that on Tesla's chart. But for Tesla, it bounced up a little bit first before plummeting more than 20%. So going back to Apple, will it drop immediately like back in 2022 Or will it have a dead cat bounce before dropping like Tesla? Well, I can tell you, nobody knows. But if you were to ask me with this death cross, I would be careful to open a bullish trade. Last but not least, bullish traders would want 166 to 168 area to hold, because this is one decent strong support zone, which Apple has bounced off 3 times in the last 6 months. Therefore, if this area gets breached, personally I don't see much support, probably all the way to 157 or 158 area. Alright, let's now move over to Tesla's chart. I think Tesla is one of the most unloved and beaten down stocks amongst the top 500 companies in US, as the share price is down about 35% year to date. Remember last week I mentioned that with all the bearish signs, I have held off selling any bullish cash secured puts. And true enough, Tesla continued to fall and ended last week down more than 6.5%. Well, I guess that was a correct call. Okay, here's something interesting for you. I think Tesla is almost there. It's about to reach a stage where I would step in to either pick up some shares or open a bullish trade. Watch on to find out more. But before that, a very quick shout out to the following viewer, Amy. Thank you for your continuous support and the various super thanks. For other viewers who would like to support the channel, you may consider buying me a YouTube super thanks as well, or buy me a cup of coffee via my Ko-Fi link. If not, do consider at least liking, subscribing and sharing my videos and channel with your friends. They say it will help with growing the channel. Okay, back to business. So in my last video and previous videos, I shared that I have been holding the view that below 180, Tesla could grind towards 160's range. I also shared this on mobile platform. And sometimes you really got to trust technical analysis and trust the process. So here we are, Tesla at 160s. So what's next? It's 160s the bottom? Well, I wouldn't bet on that yet. Because based on the technical chart, there is still room to fall towards 150's range. And within the 150's range, watch for 2 levels. One being the critical 161.8 Fibonacci level, while the other is the bottom of this downtrend channel line. I would say around 152. And since we are talking about 152, don't be surprised if Tesla continues to hit lower a little bit more to fill that gap that ranges from 146 to 152. And if Tesla ever gets to this low 150s range, I would likely step in to either pick up some shares or sell a bullish cash secured put. Okay, in case you ask, what if Tesla did not breach the 160 level? Well, that's possible too. So my plan B of stepping in is to watch for reversal from the current level. And this is quite straightforward. We just need Tesla to get back above 180 and remains above it for a couple of days. It may seem like a tall order for Tesla to jump 17 points from 163 to 180, as that is a 10% jump. But wait, it's Tesla. Anything is possible, right? Oh well, if Tesla can do that, then I potentially may step in to sell a cash secured put. But I will be very careful because the gap between 185 to 186 could be a resistance area. However, if Tesla somehow can break above this zone as well, wow, that's very bullish. That's when 200 could be in sight. By the way, just to add, we had 2 massive downgrades on Tesla last week from UBS and Wells Fargo. Sounds familiar? Something that we saw in Apple at the start of this year? And the market overreacted, remember? And if you could also recall, I traded and profited from the overreaction, something that I love to do. But for Tesla, I haven't stepped in yet to snap up any shares or sell puts is because the chart clearly shows a falling knife. In case you are not aware, I am a Tesla bull, and Tesla is the heaviest weightage in my portfolio. But for short-term trades, I make sure my judgment is not clouded by my bullish thesis of the company. I basically read and present what I see on the chart, and I try to be objective. If it's bearish, I will say it, like now. That being said, I am waiting patiently for a reverse in trend. Hopping over to Google's chart. So last week, I shared that viewers should watch the 200 moving average like a hawk, because this level has not been breached since March 2023. I also mentioned that if Google can clear the 23.6 or 38.2 Fibonacci levels, it's bullish. It may charge towards 142. In fact, I followed my technical analysis. Last Tuesday, I tried opening a bullish cash secured put as I was anticipating Google to head towards 142. Unfortunately, the order didn't get filled, and Google did exactly what I have shared as it bounced off the 200 moving average like a champion. Okay, anyway, what's next? Google is currently hitting a double resistance level formed by the 50 moving average and the 50% Fibonacci level at around 142. This is one potential rejection level, as you can see that the price has stopped out last Thursday and Friday. If Google can go above this level, don't be too happy yet, because another heavy resistance will come in at around 145, where the critical 61.8 Fibonacci level is. But again, somehow Google can clear this level as well, then Google is very bullish. That's when I will expect Google to fill the gap at 146 to 147 and even head towards the uptrend channel line, which is roughly around 150. On the other hand, if Google gets rejected at either 145 or 142, no big deal, because that's where the heavy resistance are. If Google retraces, again, I have shared many times, watch for the retest of the downtrend line. That is also the area where the 200 moving average is. This is one big support area, which is around 132 to 133. As long as this area does not get breached, any retracement in Google is healthy and gives Google a potential chance to go up higher. Just to add on, if the market is bullish this week, Google could even bounce off 139 or 136 without even touching the purple downtrend line. Lastly, okay, this is pure sensing and personal view and not much of technical analysis. Okay, well, I am thinking Google may face rejection either at 142 or 145 due to the threat of Microsoft event where they will showcase their AI products. To add on, I think the Fed may not come in too dovish given the inflation report. So I am leaning slightly towards bearish for Google this week. Again, this is just pure sensing, okay? Please do your own due diligence. Anyway, interestingly, on the longer time frame, the weekly chart looks bullish to me, as it seems like there is a cup and handle pattern forming. The only issue is we don't know how long this handle will be, so it could be a case of further decline from this point before breaking out of the handle towards all-time high. Alright, let's now talk about my option trades. The first one to update this week would be this covered call on Tesla that expired last Friday, 15 March. This is one easy trade if you have been following my videos and also understand how does options real strategy works. If you don't know what that is, please check out my video linked at the top. Anyway, a quick recap, I was assigned with 100 shares of Tesla back in 26 January with a cost price of $190 per share. With this 100 shares on 2nd February, I sold a covered call with a strike price of $200 and received a premium of $500. After selling the contract, Tesla actually went above my strike price for a period of time, and my trade was down more than 100% as the contract became as expensive as $1,200. Sorry, I didn't manage to get any screenshot of that, only had this one when it was down 20%. Again, if you are familiar with options real strategy, you will know that that was just paper loss only, and while swings for options contracts are normal. So as of last Friday, Tesla closed below my strike price and my contract expired worthless. In other words, the contract has swung from negative 100+% to positive 100%, and that's a more than 200% swing. In short, I got to keep the $500 premium without taking further action. And right now, I will wait for another opportunity to sell another covered call to milk more premiums from my Tesla shares. Next up, okay, I want to be transparent with my viewers about my trades, such that I don't only show the winning ones. So here you go, as of the time of recording, I have this cash secured put on Tesla that is sitting on a paper loss of 68%. The contract is expiring this Friday with a strike price of $160. This put option was sold back in 8 Feb 2024 when Tesla was on this mini uptrend. From then till late Feb, I could have closed the contract anytime to take the profits off the table, which I did not. I mean, hindsight is always 20 out of 20. Anyway, I will have to face the risk of Tesla falling below 160 this Friday, and that's when I need to make a decision if I want to take another assignment or I roll the contract further. Don't know what's rolling an option? Check out the video at the top. On the other hand, if Tesla somehow managed to stay and close above 160, then I don't have to do anything as the contract will expire worthless. I will then get to keep the full premium of $168 without taking further action. Alright, sharing some of my recent thoughts to wrap up this video. Well, first and foremost, I think the market sentiments are turning a little sour as investors face the possibility that interest rates could remain elevated for longer than they had initially expected. And this means borrowing costs will not be dropping anytime soon, which is bad news for companies that are going to refinance their debt in the next 12 months. This is probably why we saw 2 consecutive rate weeks in the stock market. Anyway, as a result of the latest round of reports or evidence that suggested inflation remains sticky, investors are revising their expectations in rate cuts. This recent data had probably raised the question of whether the Fed feels inflation has cooled enough to begin cutting rates later this year, and we may have some answers this week. By the way, remember a few weeks ago I mentioned as the earnings season comes to an end, the focus will shift towards the Fed's interest rate policy and inflation all over again, and clearly we are seeing that right now. I would think that the upcoming release of new interest rate forecasts will unleash a fresh wave of speculation on the timeline of rate cuts, as well as how dovish or hawkish the Fed officials are right now. But for retail investors like us, there is little we could do to control all these market speculations. We can only wait and see where the market is headed next. But regardless of where the market is going next, I must say that the recent inflation reports serve as a reminder that one shouldn't get too complacent or ahead of themselves about falling inflation, about market rally, and about Fed's rate cut policy. The path to normalization of inflation will not be all rosy and easy, and the final road to success can be bumpy at times, and we just had that little bump recently. But a saving grace for the recent hot inflation reports is that the market expectations for rate cut is finally more aligned with the Fed's forecast, which is 3 times this year. This alignment of expectations is important, which I had also covered in my previous videos. Okay, before you get all too happy about this alignment of expectations, with the new FOMC meeting and dot plot coming up, things and expectations could change again, and the market may have to readjust itself once more. That's how the market works in the near term, moving based on news, expectations, and even speculations. Meanwhile, at the time of recording, the market rally is in the midst of a pullback for 2 weeks already, which includes Nvidia's crazy and ugly intraday reversal on 8 March. To also highlight, the Nasdaq is back to about where it was a month ago. Well, I don't know about you, but in my opinion, the market rally is getting a much deserved break, and that's very healthy. In fact, so far the pullback has been quite minor, and despite being minor, it did present the first opportunity to pick up some shares of good companies, which I did for Google and Apple as shared in my previous video. Alright, I hope you know what to look out for this week, and do tune in again next week after the various key events, and let's see if we can get some sensing if the latest pullback will continue or will the market bounce back to another all-time high. Meanwhile, do help me grow the channel by simply tapping on the like and subscribe buttons if you haven't. Thank you very much.